Let's talk about S corporation taxes when operating in multiple states, okay? And here's an overview I want you to pay attention to. So first of all, how do states treat S corporations? One thing for sure, the way S corporations are taxed in New York may be different from the way it's done in Pennsylvania, in California, and Georgia, and so on and so forth. Okay, the first thing to know is that generally S corporation actually do not pay taxes at the corporate level. So you are basically filing a Form 1120S to account for your business activity, your transactions, your income, your liability, all that kind of items. But you do not pay taxes at the business level. You are filing Form 1120S, and you're also filing Schedule K1. And so it's important to understand that the S corporation shareholders are subject to state income taxes. They're also subject to federal income taxes, and they also are subject to taxes on their proportional share. The proportional shares, if you will, of the S corporation's profit. It's one of those things where you just have to know that they're not paying taxes at the business level, okay? Business income taxes. Now, not all states recognize S corporations. Really important to know. Some states do not recognize S corporations. In other words, they treat S corporations like C corporations. At the same time, you need to really understand that it's up to you to actually do your research to see what the situation is in your specific state. Now, let me give you some examples here. So you have DC, so the District of Columbia, New Hampshire, and Tennessee, all of the three states that do not recognize, if you will, S corporations. Note that you can still have an S corporation in those states though, and that can still mean big federal tax savings. But the S corporation will only be an S corporation for federal tax purposes and not for state tax purposes. So for the state purposes, the corporation will be treated as a regular C corporation. Again, I'm talking about the District of Columbia. District of Columbia, you have Tennessee, and you have New Hampshire. So those are the three jurisdictions where you don't have S corporation taxes. Now, some states tax S corporations, so you have to pay tax on your income, even though they do recognize you as an S corporation. You got to really be aware of that. Let me give an example. Massachusetts taxes S corporations on their profits when the profits rise above a specific limit. And it's one of the things you have to remember, that the laws change all the time. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. Another thing to really remember here is that some states will tax S corporations and their shareholders. So not just the corporation itself, they also have their shareholders, okay? So when the states that tax S corporations, you have Indiana and Kentucky, among others. But in terms of states that tax S corporations and their shareholders, in other words, that double taxation, you have a lot of them. So you have Michigan, you have California, you have New Jersey, you also have New York, okay? So those states, among others, they tax both the S corporation's profit and the shareholders' proportional shares of the S corporation's profit. That means that in a sense, the S corporation is double taxed in a manner similar to a C corporation that distributes all of its profits as dividends. And let me give you an example. Michigan, for example, taxes the S corporation shareholder on all of his or her income, because Michigan does not recognize the federal S corporation election for purposes of passing through S corporation profits to our shareholders. Michigan also taxes the corporation on that same income via its single business tax. Fortunately, most small businesses, the sorts that would elect S corporation status, either are not subject to the single business tax or don't pay very much a single business tax. And this is kind of cool. And one thing I need to say here is that basically in Michigan, for instance, a business is exempt from the single business tax if its gross receipts are less than $350,000 as of the date of this show. So Michigan may just win the honor of having double taxation. But hey, listen, it is what it is. You have other players, other states that do the same thing. You have California, New York, and New Jersey. Okay. And one thing I want to say here is that you need to understand that you have to pay certain taxes either quarterly or in a one-time fashion at the end of the year. You also have multi-states S corporations taxed in multiple states. So in general, if an S corporation does business in another state other than the home resident state, that other state will want to tax all shareholders. even non-resident shareholders on their proportional shares of the S corporation's income earned in that other state. And so some states actually, as a convenience, let the S corporation pay the income taxes owed by shareholders or non-resident shareholders. So this is kind of important. Now, it's important to understand that if you want to really be sure that if you have S corporation taxes and you operate in multiple states, you got to have either a great record keeping strategy, or actually you have to rely on third parties such as CPAs or EAs or even enrolled or even tax attorneys. By the way, boss, I want to quickly remind you, to this topic, we are having a conversation about S corporation taxes when operating in multiple states. Let me talk to you about the strategy you need to pay attention to if you want to actually pay less taxes, or at least comply with your taxes when operating in multiple states. One thing you have to do here is you need to really understand that there is a recognition of the federal S election. So what happens here is that for federal tax purposes, a corporation must file Form 2553. So if you're operating in multiple states, you have to really understand whether you have to file S corporation tax. You do not have to file S corporation election at the federal level multiple times. You only file it once. But at the state level, you may have this is why I'm using the word may here, because you may have to actually check with your state's revenue department officials to know what the conditions are. But at the federal level, you need to file Form 2553 to qualify. So the form is called the election by a small business corporation. So you need to file that form to gain S corporation status. Most states follow the federal government in recognizing the S election. However, Arkansas, New Jersey, and New York require a separate state S election. Okay, so you gotta really, if you happen to operate in those states, you need to actually file a separate state S election. You also got to think about income apportionment. So multi-states S corporations are allowed to apportion their income to the states with which they have nexus. So for many years, most states followed an evenly weighted three-factor apportionment by sales, tangible property, and payroll in each state. Okay, and recently, based on our research, we have been seeing that things are changing a little bit, especially during COVID and after COVID. So states have been changing their apportionment formulas. Only 10 states now use the traditional evenly weighted three-factor apportionment formula in all cases. Another 4 states allow it in some cases, or allow optional use of an alternative method. So the trend has been for states to assign a greater weight to the sales factor and less or no weight to property and payroll. Thus, states can shift the tax burden from in-state corporations to out-of-state corporations, which are less likely to have property in the states or pay workers there. So it's one of those things that are really important to pay attention to. So when we talk about S corporation taxes when operating in multiple states, it's important to understand the type of taxation we're talking about. What are we talking about in terms of taxation? Well, some states do not assess an entity level tax based on income, net worth, or capital value. So along with those without an income tax mentioned earlier, those states include Arkansas, Arizona, you have Alaska, you have Colorado, you have Florida, Hawaii, you have Indiana, Iowa, Maine, Maryland, Montana, North Dakota, Utah, and Virginia. So, however, many states assess additional taxes on S corporations in the form of franchise taxes, business privilege taxes, or other excise taxes based on gross receipts, income, net worth, or capital appreciation value. So, an unusual example of an add-on tax is New Jersey's per capita tax on shareholders of professional service firms. So New Jersey refers to this as a filing fee assessed as $150 per shareholder. So this is kind of important. You also have to think about composite returns. So many states allow multi-states S corporations to file a composite tax return on behalf of all shareholders of the S corporation. So with it, the income of each shareholder is reported to the states, and the S corporation pays the tax on behalf of the shareholder. So the advantage is that shareholders do not have to file individual income tax returns for that income, with any states where the S corporation filed a composite tax return. Okay, and the states that do not accept composite tax returns include Nebraska, Oklahoma, Tennessee, and Utah. Although Utah did issue a private letter ruling 02033 in 2003 allowing a composite return for non-resident shareholders if basically, if you have an elected small business trust, this will qualify. Some states, as we have seen recently, including Arizona, New York, and Vermont, restrict the use of composite returns based on income or number of shareholders. And application of the highest tax rate to the shareholder's income on a composite tax return is really a drawback of composite filings when you really think about it. You also got to think about estimated taxes, okay? So several states have an estimated tax requirements for S corporations, including Delaware, Kentucky, Maryland, New Jersey, New York, North Carolina, Oklahoma, Rhode Island, and Wisconsin. And in some states, composite payments are treated as estimated tax payments. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about S corporation taxes when operating in multiple states. You got to also think about withholding on non-resident shareholders. So it's really important if you're operating in multiple states. For S corporations not filing composite tax returns, many states now require that state income tax be withheld for non-resident shareholders. So some states that still do not require withholding on non-resident shareholders include Alabama, Arizona, Connecticut, Delaware, New York, North Carolina, and Vermont. Idaho began actually withholding effective this year. In addition, some states require S corporation to file non-resident shareholder agreements with their returns. So lacking an agreement or failing to adhere to an agreement, the S corporation pays the tax at the maximum rate. So this is one of those things where you do not have to get in trouble. And when we talk about federal income tax, so the federal returns attached, so most states require some portion, if not all of the federal Form 1120S to be attached to the state's corporate tax return. And some states that do not require this are Colorado, Illinois, Louisiana, Tennessee, and Texas. But in all the others, they want to see what you file with the IRS, okay? And there are other considerations you need to pay attention to when you think about S corporation taxes when operating in multiple states. So, an audit in one state may require filing amended returns in other states by the S corporation, shareholders, or both. So failure to do so may result in assessments, including interest and penalties from the other states or a missed opportunity for a refund, okay? And many times what happens here is that corporations make the S election so they can pass through anticipated losses to shareholders currently. And if a shareholder's resident state recognizes S elections, the pass-through of losses may be beneficial at the state level if the individual tax rate is greater than the corporate tax rate. Conversely, if the S corporation has profits, there is an advantage to filing an S election for that state if the corporate rate is higher than its individual tax rate. So this is kind of important. Now, here is the decision you have to really grapple with when you think about S corporation taxes when operating in multiple states. You got to really figure out what's owed when you live and work in more than one state. It's one of those things where you got to ask yourself, how do I know how much I owe in each state? It really depends. In most states, residents pay tax on their income from all sources they receive during the calendar year. Residents typically get a tax credits for taxes paid to any other state, right? So this is kind of cool. And part-year residents follow each state's rule. So some states separate the income and tax only the state's income, or a state may calculate the tax on all the income as if you were a resident and then allocate the tax based on in-state sources as a percentage of all sources. So it's one of those things where it can be a little complicated to figure out the apportionment percentage. So regardless of whether you are a part-year resident or a non-resident in the states where you are working, you probably need to complete an apportionment schedule if you have income in more than one state. And this form can usually be found in the state's part-year or non-resident income tax return. And so you will use the schedule to apportion how much of your income is taxable in each state. So you need to understand that part-year residents not only pay tax on income earned from work performed in the states, but also pay tax on all other income received while residing in the states. Non-residents generally only pay tax on the income they earn from work performed in the states and on income received from other sources within that state. So it's one of those things where you have to be a little more creative here. So now when we talk about apportionment, you have several methods actually, and the two are most prominent. So some states require you to calculate your tax as if you were a resident in the state for an entire year. In other words, you determine your state's taxable income as if you were a full year resident and calculate the full year's state tax on this taxable income. You then apply the apportionment percentage to this tax to determine the tax you owe in the new state. And then the second method is that other states require that you have to prorate your itemized deductions, personal exemptions, and certain other allowable deductions and credits using your apportionment percentage. So the taxes you pay to the new states are based on this prorated amount. And if you're a non-resident in a new state, you'll still have to use an apportionment schedule to determine how much tax you owe in each state. But the interesting thing is that you also pay a tax on all your income for the entire year to your resident states. So it's one of those things where you have to really make sure that you follow through to make sure you're not paying double taxes. Now, let me give you a bonus here. So when we talk about S corporation taxes when operating in multiple states, let's go back quickly to how S corporations are taxed. So unlike regular corporations, in other words, C corporations, S corporations really avoid double taxation because they don't pay taxes at the business level. They pay taxes at the shareholder level. Okay, double taxation refers to how income earned by a regular corporation is technically taxed twice. Once when the corporation earns income, and again when it distributes dividends to its owners, who then pay taxes on those dividends. So S corporations avoid this business tax by passing their income through to their business owners directly, as reported on Schedule K1. And so this is why, again, they are sometimes referred to as pass-through entities. And so you can actually elect S corporation. I think, as I've said before, you just have to file Form 2553. Okay. And it's one of those things where you have to actually, once the IRS approves you through after filing Form 2553, you do not have to file again for multiple, like if you operate in multiple states, you do not have to file at the federal level another Form 2553. But those states, as I said earlier, you might need to apply for an S corporation in every state where you're operating. It's important to understand that Form 1120S is an informational return. It's not a return where you pay taxes on, but you have to actually let the IRS know what's really happening. And so on Form 1120S, you have sections such as general information about your business, including your date of incorporation and the date you elected S corporation status, your business activity code and your employer identification number, your EIN, a profit and loss statement and a balance sheet for your business, and information about any payments you made to independent contractors totaling at least $600 for the year, each of whom you should have sent a 1099 form. Okay, and so you have, and on Form 1120S, you have sections such as income, deductions, tax and payments, and you also have a series of schedules that are attached to Form 1120S. You have a Schedule B, other information, Schedule D. This is where you will report any capital gains and losses. Schedule K, this is actually a form that brings together information about your business income, deductions, and tax credits your business qualifies for. You have Schedule M, you have Schedule M1, and Schedule M2. So this is kind of cool. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about S corporation taxes when operating in multiple states. So let me do a quick recap here. So I give you the overview, the strategy, the decision, and the bonus. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.